All right, testing. All right, we should be live now. All right, guys, good morning. Good morning. Welcome aboard to the Morning Note. My name is Carlos Garcia, founder and CEO of GAR Capital. It is Friday, January 13th, 2023, 9 a.m. Eastern Standard Time, 9:02. Just did a quick reel on Instagram. Let's go ahead and get to it. Bottom right-hand corner of your screen, if you're new to the channel, make sure to click that button, turn on notifications, subscribe to our channel, make sure to like these videos. And again, if you don't have time to watch it in the morning, you can watch it at your leisure anytime. All our channels, all our videos are up on YouTube. I think we've been doing now the Morning Note for a couple of years now, so it's been always fun. Let's go ahead and get to it. Dow futures down about 288 points this morning. Nasdaq down 1.19%, and the S&P down 1%. Russell 2000 down about 0.92%, 1868. Crude oil is up about 0.5% this morning. 78.78 a barrel, 246 for gasoline futures. Gold continues to rise. That is now at 1903 an ounce. Silver futures 23.80. Remember when that thing was right around 17. Copper down about 1% this morning, 4.15. Let's go ahead and take a look at the euro dollar. We talked about that before, 107.85, still holding up, down about 66 pips. Dollar yen 128.29, down about 104 pips. Now, I'm going to talk about the yen today because it's very, very important, and we're going to talk about the correlation with the Japanese yen and 10-year yields. Again, we want lower rates, right? So again, the yen may lead us there or lead that correlation. Pound dollar down about 61 pips, 121.55. Bitcoin taking back of a breather, was at 19,000 yesterday on the futures side, down 1% this morning, 18,945, 1407 for Ethereum futures down 2%. 10-year yields 3.474 this morning, 102.62 for the dollar. Again, dollars up, stocks down, kind of basic. We know that, at least in this environment. VIX, that's something else we're going to look at today, 1933, down, up about 2.71%. Let's go ahead and start the bank earnings. Let me see if I can bring that up. I know I had that. Here we go. Here is bank stock slip as investment banking revenues decline. Jamie Dimon, the CEO of JP Morgan, stated that there is still economic headwinds, that now his base case is a mild recession, not an economic hurricane like he stated last year. Looking at all this information, again, there's a ton of it. Went ahead and retweeted all of the numbers. We just also got buybacks announced for JPM, about $12 billion. We had BlackRock report today. We had JPM report today, Wells Fargo, Citibank, and Bank of America. Now, in terms of what's moving and what's shaking pre-market, let's go ahead and go over it together and see what exactly the market liked. Let's see here in terms of pre-market. Okay, stocks are not showing pre-market. Pre-market stocks. I know the one I can get it from is Market Watch. Let's see, Market Watch. Here we go, pre-market screener. I usually go investing.com, but didn't happen today. Virgin Galactic is up 14.72 this morning. Another meme stock up today. Carvana's down, talks of more layoffs, more letting go of people, 7.72% of the downside. Tesla was a double downgrade today, down 6%. Delta Airlines, we took those calls, well done. That is down 5.43% after their earnings came out today. Their forecasting was not as expected. American Airlines is down 3.74% after yesterday's boost on their preliminary earnings. Bank of America down 2% this morning. Again, kind of the big theme here in terms of banking is investment banking revenue decline. Less IPOs, less M&A, less deal making, less liquidity. So again, that's kind of the same thing that we've been talking about. I still like banks moving on in the future. But again, in terms of the earnings reports today, you can see we're getting a little bit of a step back, but they were running up into earnings past couple months. JP Morgan down about 2.62%. Citibank's basically flat. Wells Fargo doing the worst, down about 4.16% this morning. UNH also reported earnings. And again, I love UNH. I own UNH. But again, I think we're going to start seeing a little bit of rotation out of healthcare. They were a nice winner in 2023. the market seems like it's trying to find a little more risk as interest rates fall. So again, if anyone here has been along UNH and you want to take some gains here, maybe lock some in for the new year. Again, you have 441 as support, but right around 500 isn't a bad deal. Again, if you need the money, if you want to take the profits, by all means, go for it. In terms of more upside for UNH, I just don't see it here because I see the rotation out of healthcare. We've been seeing the past couple of weeks, Humana and these names pulling back, and UNH. And UNH had a great quarter. I think in the environment that we're in, if we see the dollar and interest rates continue to go down, UNH kind of loses its luster. Value stocks will be rotated out. So again, like Coca-Cola, Procter, guys, these are expensive names now. And we're going to go and take a look at the forward PE ratio together. Let's go and take a look here. Forward PE ratio, again, we don't have all the earnings yet. We just got the banks. And look at the names in terms of PE ratio and how expensive they are. Now, relative to growth stocks, relative to like an Amazon or a Tesla or a Google or an Apple or a Microsoft, again, those are growth companies. So again, you're expecting for them to have a little bit of a higher multiple just for the fact that, again, they are always investing in growth. But when you look at a Walmart, a Coca-Cola, a Costco, a PepsiCo, Procter & Gamble, Colgate-Palmolive, Philip Morris, you're kind of stuck a little bit of a ceiling there in terms of growth. Coca-Cola is not going to grow more than, in terms of revenue, maybe 1% to 2% a year. And again, it's not a bad place to put your money if you want to be, kind of conservative, and that's fine. I have nothing against Coca-Cola, but at 24 times earnings with really zero growth prospects, I mean, are they going to acquire another company or something? It just gets to the point that it's a little too expensive at this very moment. Costco being another. And again, I like Costco, love Costco, but again, they're starting to get a little ahead of themselves. And again, markets just rotate, guys, to the new thing. It's just kind of how it goes. What's going to work now versus what's going to work, what worked before, and then you swap back and forth. Healthcare, you can see a little bit of a pullback, but in terms of their PE, so again, it's still a little cheaper there, like a Pfizer and AbbVie, Bristol Myers, for example. Banks still relatively cheap. Book value, I have not looked at their book value today because there was a bunch of earnings coming in. Energy still relatively cheap. We know they make money. We'll see their earnings as well. But I'm starting to see, at least in the latest approach in terms of the stock market, that we're getting a little bit away from those names in terms of healthcare and energy. Now, again, nothing wrong with energy in general, but again, it did get a little bit of ahead of itself. So let's go ahead to year-to-date performance, right? Healthcare being the laggard. Energy up about 2%, but look at the cyclicals, 7%. Real estate is up. Again, all the interest rate sensitive names, cyclicals, real estate, communication services, they're outperforming at least year to date. Now, granted, it's only 13 days in, but if we start seeing more and more gradual declines in the treasury bond market in terms of yields, you're going to see those sectors actually increase. And again, energy, utilities, healthcare, they're going to be, and defensives are going to kind of be held back. I don't think they're going to fall 20% or anything like that. No, but I do believe that you're going to get that rotation out. You're going to see a little more of a push into riskier assets, trying to catch some alpha, especially with a downward trend in terms of the dollar and yields. So that brings me to the S&P 500. Again, one of my favorite things to look at. And again, you could see here S&P 500 futures. We did close, mind you, above the 200-day. We are now below it here. Let me see here. Give me a second. So we could see here this trend line that we have been rejecting pretty consistently since the beginning of 2022. We had it in March, end of March. We had it in August, and then we also had it in December. But again, we're getting another wave there. So again, we have to get above 40.40 and settle above so we can get back to this channel to the upside. What is the key to get there? Of course, guys, it's the dollar. Let's go ahead and take a look at the dollar together. And the dollar, again, our next support level is 101.62. You could see that support right there, that 786 fib. We did break below this trend line on the larger time frames. So again, 101.62, we need to go ahead and break that. That's the main move today that we're looking for. We're still below the previous support of 103, if you remember that. So again, 103 being previous support, that is now our newest resistance. And again, as long as we stay below there, I think we kind of stabilize around here on the S&P 500. In terms of the S&P 500, back to the daily chart. Again, we're still above momentum moving averages, the 20-day moving average, the 50-day moving average. You can see the 200-day is starting to creep a little lower, yet the 50-day moving average is creeping higher. Could we get that golden cross that we've been talking about on the NYSE and the equal weight S&P? The equal weight S&P is basically ahead of the game because NASDAQ has been underperforming so much. And again, we need to adjust the weighting in terms of those indices. But I don't see any change in terms of removing something in and out of the Dow or the S&P anytime soon. But again, tech is such a big part, a heavyweight part of the S&P. As they move down, like a Tesla or an Apple, again, you're going to see a slippage into the S&P. And of course, you could see it here. The NASDAQ is underperforming the S&P in general today, 1.09 versus 1%. Not a huge spread, but again, you could see that there. So more than likely, we could be hovering around the 200-day for the rest of the day. We do have a long weekend coming up on Monday. So again, another short week and another long weekend for us. Let's go ahead and take a look at the thing that I wanted to discuss today. Let's go ahead and take a look at the dollar yen. And the dollar yen, unless you're a currency trader, you pretty much don't care, and I get it. 126.56 is the support that we had in May. Now, here's something extremely interesting. Let's go to studies. We're going to go ahead and add a study. We're going to compare it with TNX. This is the 10-year Treasury yield, not the 10-year Treasury bond. And you could see that, again, pretty close in terms of correlation. Pretty damn close. And you could see that we still have a gap here from the yen. So if the yen continues to fall, again, the dollar slipping against the yen, Treasury yields have a little more to go. So again, where does that put us on a 10-year? If we were just to match that support of where the yen is going to, we should be around 2.6% Treasury yield. Now, does that mean it will happen? Not exactly. It doesn't have to happen. But again, something to look at. I still think Treasury yields continue to fall. I still think we'll break 3% by this year. And again, how is that going to help the market? How is that going to help recession? Doesn't that hurt inflation? Well, now you're going to start getting a little bit of a boost into real estate. People are going to be able to refinance those rates that they had last year. And again, that's more savings. That's more work for banks. That's more underwriting. That's more jobs. That keeps things stable. Again, Treasury yields have to keep coming down. That's the key, and the dollar as well. But again, we do have a nice sizable gap between that pretty much one-for-one correlation that we've had recently from the yen and the 10-year Treasury. So again, if you're seeing the dollar yen fall, keep that in the back of your pocket, like, maybe yields are going to fall too. And it kind of is a self-fulfilling prophecy. So again, guys, if you think that a recession is happening, then you definitely want to be in safe assets like Treasury bonds. And you want to lock in these yields because the expectation is, hey, if we go lower, we may have to cut. That's where you start getting the demand now. That's why you start seeing bond yields start falling. So again, you could say, I want to buy bond yields because interest rates are so great as a saver. Or you could buy bond yields saying that I want to buy something safe if we continue going down. And then the funny part of that is, as those bond buyers keep buying those bonds, that's adding more liquidity to the system. That's actually helping the stock market, interesting enough. Let's take a look at the HYG. This is the high yield credit markets. Very important to look at. Let me remove this study. We're going to go to edit studies. We're going to compare this TNX comparison and look at the high yield credit markets. We are now above that trend line, very similar to the S&P 500, above the 200-day moving average, which the S&P has not broken yet. We also have another gap to fill to the upside. Take a look at this. Right here on the daily, we got a gap to fill right at 78.21. So again, if we get people saying, oh no, things might get worse, let me go buy bonds, that's indirectly helping the market add more liquidity, at making borrowing costs lower. So again, you know where I stand on this, guys. I still think the bottom was in October 11th. That's just me. And high yield credit spreads are actually making me feel a little better about that call. We'd love to see us break 76.87. Let's see if bonds catch a bid moving forward. And if they do, then we're going to expect rates to go down as well. Pretty much the Super Bowl was yesterday in terms of the economic data. We had CPI yesterday. Again, that met expectations. Now we're reversing from that 200-day moving average. We took a lot of profits this week. Well done, guys. The only one that did not work for me was Alibaba because I got chopped. Had the break the way I wanted it, but again, it just chopped around, killed the premium. So that's where we are, unfortunately. The only one that I didn't catch this week. Other than that, we had a great trading week. But I have high expectations for myself and the team. I'm sure you guys do as well. So again, I'm not satisfied. We need to keep going and keep pushing and see what else we get. It's just good to see some momentum, even if it's upside or downside. The last thing that we want is chop. We do not want choppiness. 20 handle range on the S&P. That doesn't help anybody. But with that being said, guys, have a great rest of your weekend. I'm going to go and work on the newsletter this week. I will make sure to get it out for you guys. I got videos to do this week for Investment Club. Got a ton of stuff to do, ton of reports. Luckily, I have a long weekend to do it. NFL playoffs this week. Cowboys play on Monday. I will not be on YouTube on Monday because it's MLK Day. Markets are closed. But go Cowboys. God, just beat the Bucks. And what I did, I know a lot of friends of mine will probably not be happy. I put $100 on Tampa Bay Bucks money line. I put $100 on the money line on Tampa Bay Bucks to hedge against my emotions. So if the Cowboys do lose, at least I win something. And if the Cowboys win, I'm happy regardless. So go Cowboys, but we're playing against the greatest of all time. God help me. They don't make it easy for me, that's for sure. So have a great rest of your morning. I will catch you guys on Tuesday for the morning note. Thank you guys so much for the views and support. We appreciate it as always. I will catch you guys on Tuesday. Have a great long weekend. I'll see you on Twitter. Cheers, guys.